Welcome to The Deep Dive, your shortcut to being truly well-informed. Today, we're diving into the second quarter 2025 results for Sensient Technologies Corporation. They're an ingredients company, but there's a really compelling story unfolding here.
Definitely more than just quarterly numbers with Sensient. This quarter gave us some really robust insights, especially if you're tracking long-term strategic plays, in food and beverage. The headlines might have caught that slight revenue miss, but honestly, the underlying performance and the future outlook, it painted a pretty bullish picture for investors.
Okay, so let's unpack how they're positioning themselves, especially with these market shifts happening. Let's get straight into the numbers for Q2 2025. So, Sensient delivered an adjusted EPS earnings per share of $0.94.
Right.
And that wasn't just a slight beat, it was $0.06 above what analysts expected. That feels like a strong signal right away.
It really does. Speaks volumes about their operational control, I think.
In the GAAP EPS, the standard accounting number was $0.88, right in line.
Exactly. So the EPS beat shows good cost management. Now, on the top line, revenue was $414.2 million. That's up 2.7% year over year. But yeah, it did slightly miss the consensus estimate.
Okay.
But here's where it gets really interesting and where the market seemed to focus. Operating income really surged by 16.2% to $57.7 million.
Wow, okay.
And adjusted EBITDA, that core profitability measure climbed 14.1% to $80.0 million.
That's strong leverage.
It is. And maybe even more telling was the margin expansion, a very healthy 210 basis points.
So 2.1 percentage points higher margin.
Precisely. Reaching 19.3%, that's clear proof they're growing more profitably. And cash from operations looked good too, up 10.2% to $48.3 million.
That margin expansion really stands out. Okay, let's break it down by segment. The color group. Wow, an absolute standout. Revenue grew 6.9% to $179.3 million, but the operating income skyrocketed 23.6% to $38.9 million.
Huge jump there.
And their adjusted EBITDA margin hit 25.1%. That's up 290 basis points, so almost 3 percentage points.
Yeah, color was definitely firing on all cylinders.
Now, looking at flavors and extracts, revenue was actually down slightly, 2.8% to $203.3 million.
Right, and they mentioned that was mainly softness in natural ingredients. We can get into that.
Yeah, but despite that top-line dip, operating income was up 8.8% to $28.5 million. So again, profitability improving.
Tells a different story than just the revenue number, doesn't it?
It does. And just quickly, Asia Pacific looks solid too. Revenue up 10.8%, operating income up 13.5%.
Yeah, good contribution there. But what's truly fascinating, I think, beyond these solid numbers is Sensient's long-term strategic vision. That really came through on the call.
You mean the natural colors push?
Exactly. They made this big shift, arguably quite presciently over 15 years ago, investing heavily in the tech, the production, the supply chains. They're not just dabbling. They flat out said they see the U.S. conversion to natural colors as the single biggest revenue opportunity in the company's history.
That's a huge statement.
It is. It shows this isn't just, following a trend. It's leading it.
And it's not just talk, right? This transition is being pushed by actual state-level actions. Hard deadlines.
Absolutely. They tracked over 112 color-related bills just in 2025 across state legislatures.
Wow.
And you've got specifics like West Virginia banning synthetic dyes by January 1st, 2028. Texas has new labeling rules for synthetic colors by 2027.
And the big food companies, the CPGs, they're setting their own targets too, often around the end of 2027.
Right. So 2027 is shaping up to be this pivotal year. It feels like this conversion is going to accelerate significantly. It's not speculative. It's pretty much mandated.
Okay, so the demand seems locked in, but that raises a big question.
Can they actually meet it? Yeah. Management was very clear on this. The natural color conversion is currently supply chain constrained.
Supply chain constraint. Okay.
And Paul Manning, the CEO, said something really striking. He said, and I'm quoting here, if the United States wanted to convert tomorrow, they couldn't because there's simply not enough raw material available.
Wow. That really hammers home the scale of this. The U.S. literally couldn't switch if it wanted to right now.
Exactly. It underlines the challenge, but also, the opportunity for companies like Sensient that are prepared.
So what does this mean for their spending, their capital allocation?
Well, they're putting their money where their mouth is. They aggressively increased their CapEx guidance for this fiscal year, FY25.
Right, I saw that.
Up to about $100 million. That's a big jump from the previous $80-90 million range.
And they expect it to stay high next year, too.
Above $100 million in 2026 as well, they anticipate. And this spending, it's almost entirely focused on expanding natural color production capacity.
So they're building it, hoping the demand will absolutely be there. Is there much risk in that level of investment, or is the regulation basically underwriting it?
Well, it's always a calculated risk, right? But management clearly sees it as, let's say, highly de-risked by all this legislative action. The CEO's comment highlights that the bottleneck isn't really CPG willingness or consumer demand anymore. It's the physical infrastructure. It's the raw materials.
So by spending now, Sensient wants to be the go-to supplier when everyone has to switch.
Pretty much. And they're also innovating on the product side, which is crucial. They mentioned their microfine range for snacks, getting those bright reds and yellows naturally.
Which can be tricky with naturals sometimes.
Exactly. And also their FDA-approved butterfly pea flower extract for blues, greens, purples. These technical solutions are key for customers so they don't have to sacrifice how their products look or perform. That technical edge really helps solidify their position.
Okay, and it's fascinating how that links back to the segment results. You mentioned the strong growth in the color group,
Right.
but management specifically said those gains are not yet from the big natural color conversions driven by those looming deadlines.
Exactly, which implies, it implies there's a substantial runway for growth still ahead as those deadlines get closer and closer.
So the current strong growth is almost like a bonus before the main event.
You could sort of see it that way. It shows their existing business is strong even before this regulatory wave fully hits. Now, switching back to flavors and extracts, that natural ingredients part.
Yeah, the onions, garlic, capsicums,
Yeah.
they had some headwinds there.
They did. Lower sales volumes, higher costs. It was mainly due to a crop issue last year, a downy mildew blight.
Okay, so an agricultural problem.
Right. And they expect that drag to continue until year end. But they do see an inflection point late Q4 and expect a nice turnaround in 2026 as the current crop comes in with a better cost position.
So sounds like a temporary issue, not a fundamental business problem.
Seems that way. And despite that specific headwind, their core flavors, extracts, and flavor ingredients still grew 4.6% in local currency.
Shows resilience in the core business.
It really does. And it leads nicely into one of the key drivers for the overall margin expansion across the whole company. They kept talking about quality through mix.
Right, quality through mix. It sounds a bit like corporate jargon. Let's unpack that. What does it actually mean in practice?
Yeah, it can sound that way, but it's a really important strategy for them. It's not just about selling more stuff. It's about deliberately selling more of the profitable stuff.
Okay, so how does that look different in flavors versus colors?
Good question. So in flavors, mix means selling a higher percentage of their more complex, technically sophisticated flavor systems and ingredients. Think custom solutions, things that require a lot of R&D and application know-how. Those naturally command better margins than, say, more basic ingredients.
More value added, more defensible.
Exactly. And in colors, it's a similar idea. They're focusing on the really precise, technically demanding natural color matches, again, custom complex formulations. These are much more profitable and harder for competitors to replicate compared to simpler, maybe lower margin natural color applications. So this focus on higher value products is boosting profitability, even if overall revenue growth seems moderate.
That makes sense. It's about the type of sale, not just the volume. Okay, moving to their updated guidance for the full year, FY25. What are the key changes?
Okay, so for the full year, they're sticking with mid-single-digit local currency revenue growth. So roughly 3-6% excluding currency effects.
So no change there.
But here's the important bit, the upgrade that the market liked. They raised their adjusted EBITDA guidance. It was mid to high single digits. Now it's high single digit growth.
That's a solid vote of confidence in those margins holding up.
Definitely. And adjusted EPS is now pegged at high single digit to double digit growth. GAAP EPS is projected between $3.13 and $3.23. That does include about $0.20 for what they call portfolio optimization costs, likely one-off costs for streamlining things.
Got it. So underlying profit picture strengthening, even with those costs. Just to reiterate that CapEx number.
Yep, now guided to about $100 million for this year and expected to stay above that level in 2026 too, really hammering home the commitment to building out natural color capacity.
So given this whole picture, this multi-year strategy, what are the key takeaways for investors? What should people be watching?
Well, I think the big takeaway is that this strategy positions Sensient to grow its earnings per share faster than its revenue. That's driven by that favorable mix, getting more efficient as they scale operating leverage and deploying capital smartly into this natural color opportunity.
A powerful combination if they execute well.
Exactly. So catalysts to watch. Any updates on how FY25 is progressing in the Q3 call? Any big announcements from customers about rolling out natural colors? More regulatory actions, state or federal? Also, watching for that natural ingredients business to stabilize later this year. And crucially, continued improvement in gross margins in the color segment as all that new capacity starts coming online.
It really is an ingredients company playing a long game, capitalizing on these regulatory trends.
Absolutely. And the markets seem to recognize that, looking past the slight revenue miss to the margin execution and that long-term growth story.
You really see them funding their future growth here. That CapEx isn't just a number. It signals real confidence in capturing that demand surge from 2027 onwards. All right, let's transition now. Let's move into our This Is Not Financial Advice segment. Given everything we've just talked about, this impending supply crunch, the legislative mandate, it makes you think about wider ripple effects. So let's speculate a bit. What's an outrageous but plausible trade idea here?
Okay, yeah. Thinking about that aggressive CapEx, building infrastructure for a mandated market, and the CEO saying the raw materials aren't even there yet. Here's a thought. A natural color capacity futures trade.
Okay, interesting. So not just Sensient stock itself.
Right, although their actions are the trigger, the signal. The idea is maybe taking a long position in the actual agricultural commodities, the raw materials behind the natural colors.
Like the specific fruits, vegetables, botanicals needed for those pigments.
Exactly, and you'd pair that perhaps with a short position on a basket of synthetic dye manufacturers. Their demand is likely to face serious pressure.
Okay, so going long the constrained resource, short the outgoing technology.
Right.
What's the outrageous but plausible part?
The element here is trying to front-run the entire supply chain impact. As 2027 gets closer and all these CPGs have to switch, the demand for those specific botanicals could just explode. Prices could go vertical.
You could see the farmers growing those specific crops suddenly having huge pricing power.
Potentially, yes. Maybe localized agri-inflation for those specific crops. You might even see new vertical integration plays, companies trying to secure their own supply. So the trade leverages Sensient's CapEx as a leading indicator for a much broader repricing across the whole color supply chain, betting on that physical resource constraint, hitting that regulatory-driven demand wall. It's a bet on a whole industry transformation, really.
A fascinating angle. Okay, let's wrap up our main discussion on Sensient. Solid Q2, strong EPS beat, impressive margin expansion. But the real story, as we've discussed, is that long-term strategic focus and the big investments in natural colors. It really positions them for significant growth as the industry makes this shift.
Yeah, the slight revenue miss seems secondary to the market. Confidence appears high in the strategy and execution, especially on capitalizing on this almost inevitable conversion to natural colors. They're playing the long game.
Definitely. Now remember, the views and ideas discussed here on the Deep Dive are purely for informational purposes. They are absolutely not financial advice. Always do your own research, your own due diligence before making any investment decisions.
Absolutely.
We really appreciate you tuning in. And maybe this conversation gets you thinking about other industries, other supply chains, where similar regulatory or consumer shifts might be creating constraints and opportunities just below the surface. Something to ponder. We look forward to our next deep dive with you.